Good morning, everybody. Hey, welcome to Wednesday. It is February 22nd. This month is quickly getting away from us. Before we know it, we're going to be saying it's March 1st. I hope your week's going well so far. Yesterday was not a good day on Wall Street. We'll talk about that and more when Dave joins us here up in just a second or two. Before we do that, though, let's not forget that there are so many things in this world that we just cannot control, but we can control, and you can control how much risk you have in your portfolio. If you know how much risk you have and you know how much risk you should have, you can take control. That's why I developed the Core Retirement Design. Give us a call at 863-382-0037. Hey, with that, we got Dave coming up next. Glad you're with us this morning.
105.7 Light FM. Every once in a while, Phillip, Statler, and I try to figure out what in this Sam Hill is causing this mess, and I let the record run out. It is time to check in on your finances and see what the Sam Hill is going on Wall Street this morning. Boy, it was a mess yesterday. About the only people that made any money yesterday were people that owned the VIX because the volatility index went up like a skyrocket. Phillip Statler is on the line. Did I give you time to catch your breath yet this morning, Phillip?
Yes, sir, buddy, it is. And I'm not sure exactly what happened yesterday, but it was a doldrum day. It was a huge drop.
It really was. I mean, yeah, pretty much everything went to heck in a handbasket. The Dow was down by 697 points. That's a full 2%. Standard & Poor's off by a full 2%, down 82 points. And the NASDAQ was down by 2.5%, down almost 300 points yesterday. Like I said, about the only people that made money yesterday were people that bought the VIX.
Yeah, it definitely was. It was a painful day yesterday. And I think, if I'm not mistaken, that's probably, if it's not the worst day this year, it's got to be close to one of the top three anyway.
According to one of my tip sheets, it was the worst day of 2023 so far, and I was kind of giggling, and we were killing time on the phone beforehand. One of my tip sheets, the headline is, "Why the 2023 rally might be in trouble." What do you think was your first clue, huh? This is what happens when 20-year-olds write financial tip sheets. One of the things, J.P. Morgan came out and said basically the damage is done, which kind of sings the hymn that you and I have been singing now for months and months and months, with this flurry of rate increases and rapid rises in interest rates. And I've been saying for a long time now, really, I mean, in absolute terms, the interest rates aren't obscenely high, but the speed with which we brought them up all at once, J.P. Morgan says damage is done, there's going to be a plunge, and we're going to have a recession whether we like it or not. And then you found a Fed governor who thinks that we can do even worse, huh?
Oh, well, I think we can do better. He says we can raise interest rates. We need to get as fast as we can. We need to get that 5.4% target rate, and then figure out where we are and whether we need to raise more or we need to start dropping interest rates. And he thinks if we do that, we can avoid, we have a good possibility anyway, of beating inflation without creating a recession.
And my first reaction to that was asking whether or not he's got a medical marijuana card, because that kind of goes right against the trends that you and I have been seeing, and basically against basic economics too, because we know darn good and well that we're just beginning to feel the effects of the last 3 to 6 months worth of increases in interest rates. And yeah, we're going to end up slowing down the economy, but the problem is you do another 0.5 or 0.75% coming up in March, and what's going to end up happening, we're going to feel that coming about October. And by then, like J.P. Morgan says, the damage has been done. Now all we have to do is figure out how to fix it.
Exactly right, Dave. And so, I get what he's saying, and but I just don't see the merits of it, really. I think that the one key thing that I see that is an issue is the whole labor market. When there's 10,000 job openings or 10 million job openings, and we only have 2 million people looking for jobs, that continues to be a problem. And so if we continue to have wage inflation, I'm not sure raising interest rates is going to be able to knock that and cut it off in the bud, because there's too many jobs out there. They may not be the exact right jobs, but they're out there that people can have. And so I think that's going to continue to be an issue with this whole deal.
And that is the challenge. I mean, okay, and you made a really valid point, and we always have to say this because there are people with legitimate challenges in the world on the employment front, but, there is a job. It may not be the right job, and it may not be paying what you want it to. And the problem is we get to the point of all we do is we bump those interest rates up. I can't believe it. I'm blessed with pretty good credit at the moment. And I got a junk mailer the other day saying, hey, here's this fancy new credit card that we'll let you have. No annual fee. Of course, then I look down the line, and the interest rate on the thing, something like 34% on the stupid thing. And that's a guy with an 820 credit rating being offered that crap. The interest rates are going to kill the consumers, because if they're not being employed to the extent that they want to be, they're running up credit cards, and the interest rates are doing nothing more than creaming that, and that's a ticket for a recession again.
It really is. And those chickens are going to come home to roost, right? And when they do, the whole credit card market's going to fall apart. And we're going to see a lot of missed payments, a lot of defaults, and that's going to really be a pushing point across the board, because then people can't spend money. They don't have any credit left to go spend money.
And this is it harkens right back. We're trying to use just one tool in the toolbox to beat inflation and beat and beat things into a normalized economy. And the problem is we're trying to do it all with monetary policy. And now I'm just harkening back to my old economist roots. It has to be addressed by the fiscal policy side of things. And that means that we got a few members of Congress, like, maybe about 535 of them, that need to grow a pair and start actually, giving us a little bit of restraint in terms of the spending policy, because fiscal is the side.
You want them to quit spending money, Dave? You want them to quit spending money?
I mean, I realize it's heresy, Phillip, but it is really the only way I know, don't you?
I agree, but they spend money like drunken sailors up there. It doesn't matter which party's up there.
Absolutely. I mean, there are two tools in the toolbox. There's monetary policy and there's fiscal policy. And the problem is the only tool we're able to lean on is monetary policy, because the fiscal policy just keeps running out of control on a regular basis. And we're going to end up hitting a recession just on the grounds that it's going to be monetarily generated before it's done. And there's my economic lecturette for the day. The one report that came out early this morning was mortgage applications, and it was not good news. With a bump up in mortgage rates, mortgage applications fell another 13.3% last week, and it kind of leads us into the first report that you had from the companies reporting. One of our big home builders reported this morning. How did Toll Brothers do?
Well, Toll Brothers ended up with a pretty decent quarter this last quarter. If I can scroll to the right place here, there they are. So they beat expectations by about 31 cents, or almost 31 cents a share. Revenue came in a little bit above expectations, not much, but that's better than the alternative, right? And so we've got Toll Brothers actually up a little over 2.5% this morning.
It's nice to have good news to lead these numbers for a change, isn't it?
It is. Hey, we didn't talk about this before we went on the air, but I did want to mention it again. You talked about mortgage rates, which are interest rate sensitive. I just wanted to tell you the 2 and the 10 right now. I mean, the 10 and the 30 right now are oscillating between 2 100ths and 3 100ths of a percentage difference before the 10-year takes the 30-year.
I was going to say we're real close to an inversion on those two. I'm looking at it now.
Very close, very close. But we do have some other companies that reported and did pretty well. I mean, one company that really kind of hit it out of the park was Palo Alto Networks, and obviously they're a software company, but they beat on earnings, beat on revenue it was their second quarter. They beat the expectations, and this was the third consecutive quarter that they've been profitable. After a decade of losses, Dave. So that's some pretty good news for that group, and so they're trading up almost 10% this morning.
That's good news. They aren't on my list as winners and losers because they're not in the S&P 500. I don't think. At the very least, they didn't show up on my list. But they're a long-term company. They're almost a dinosaur in high tech, aren't they?
Yeah, they really are. They've been around for a long time. We got Coinbase. Imagine that, right? The cryptocurrency exchange.
If you tell me they beat, I'm going to drop my false teeth.
Well, they did beat. They had but they still lost They still lost a bunch of money though. They lost $2.46 a share instead of $2.55 a share. Revenue was actually better than expected by $40 million. So yeah, so they saw some good numbers there. They are trading down, obviously, about 1/3% because they still are losing money. We had Intel reported.
Ooh.
And yeah, so I'm sorry, I don't think they reported, but they came out with an announcement that wasn't good news. They cut
what are they doing?
They cut their dividend.
Uh-oh.
To 12.5 cents a share. And that's never good.
That boils down to a poison pill almost during earnings season.
It really is. And so they're saying, look, we need to take prudent allocation of our owners' capital in order to be able to implement their new strategy, their IDM 2.0. Must be a new chip or something they're working on. But so yeah, anyway, so they're trading down almost 0.7% today. We do have, well, I thought Lazy Boy was going to be up, but Lazy Boy is not trading up right now for some reason, but they had a good quarter. I mean, they beat expectations. They came in at 91 cents a share versus 66. Revenue beat by, man, close to $40-50 million. So they had a really good quarter. Not sure why, because they were up earlier, like 4%. Now it says, well, I take that back. The index hasn't traded yet. I mean, the stock hasn't traded yet this morning on the futures. So it's still showing me the number from yesterday. And yesterday it closed down 4.7%. They're saying today that it should pop by about 4% this morning. So we'll have to wait and see if anybody's going to jump out there and start to try to buy it yet.
Sounds to me like it'll at least make up what it lost yesterday, right?
I'm hoping so. And then the last one I have for you is Garmin. And Garmin posted a fourth quarter that beat the consensus estimates across the board. And so that was good news for them. They are trading up 3.25% this morning.
Cool. Well, resetting the table here this morning, and again with the 2 p.m. release of the Federal Open Market Committee meeting minutes from last month, it could be a seismograph at 2 p.m. It looks like a lot of people are sitting on their hands. Bloodbath yesterday, 45 minutes before we open. How are we looking this morning?
Dave, right now we've got just a tinge of green ink, definitely not enough to make up for yesterday's decline, but we've got the S&P 500 up about 0.2. The Dow Jones Industrial 30 up almost 0.2, and the NASDAQ 100 up 0.3. So everything's in the green, but that could change really quick. On the other side of the coin, we got silver trading down 0.25%. We've got gold up a little over 0.1%. Crude oil is taking a big bath today, Dave, or took a bath yesterday, and it's down more this morning, down 0.6 this morning, but it's down to $75.88 a barrel right now.
Could we maybe see a decrease at the pumps? That takes a couple of weeks, but I'll take it happily. Overseas markets, everything is in red ink. Asian markets said to heck with you and pretty much sold this morning. Everything was down at least 0.5%. European markets are also off, not big, but off midway through their day. Keeping tabs on an employment account, a retirement account by watching the daily stock market is not good business. How do I find you to get a plan so that what you and I talk about every morning is kind of entertainment value, Phillip?
Well, yeah, that's the one thing, is that there's one thing in this world that we can control, and that's your risk in your retirement portfolio. Give us a call at 863-382-0037 to walk through our core retirement design, where we focus on the risks that are out there. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730, 95.3 FM.
And back here tomorrow morning to tell you what the Fed minutes said and all the rest of the stuff that could affect your money tomorrow. Phillip, you have a good day, and I'll see you then.
All right, man. You have a great day, and I will talk to you in the morning.
Thank you, sir. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Listeners, again, I want to thank you for joining us. Don't forget, it's the risk in your portfolio. The closer you get to retirement, that's very, very important. Give us a call, 382-0037 to schedule your core retirement design. Hey, with that, have a great day. I look forward to speaking to you again tomorrow. Same time, same place.